Good afternoon, everybody. Happy Wednesday, and welcome on in to today's show. So excited to be back on live together with my friend Peter Giannoulis, the CEO of A2 Gold. A2 Gold has been having quite the start to the year. Obviously, this area of gold, silver, precious metals has been on fire, but people have questions. Is the run over, or maybe has it just begun, or are we in a middle ground? We're going to talk about that and why the run's not over, but also where the real opportunity is, because it's not right now in just buying gold directly. It lies elsewhere in our opinions. Let's talk about it. Peter, welcome to the show.
Hi, Gav. It's great to be back, and excited to talk about the gold and silver and markets, as well as A2 Gold.
Beautiful. Before we get started here, because we are going to be talking about A2 Gold, and the ticker there is AUAU.V. You can find it on the TSXV as well as OTC. Want to give a quick disclosure here that this live stream for AUAU.V is a paid advertisement. It is intended for informational purposes only, and it's not a recommendation or endorsement of a specific stock or strategy. Investing involves risks, including the possibility of losing your principal. So please always conduct thorough due diligence prior to making any investments, or consult a licensed financial advisor if you feel the need to. With that being said, let's get into it. So, Peter, you have made some great predictions, specifically on our last show. We talked about the spot gold price, which we can pull up right now, and spot gold is trading at 4,961. You did talk about us getting to 5K, which we did. We almost got to 6K at one point this year. I believe we topped out right underneath it at 5,591. So gold has settled back down a little bit, but also in our last show, one of the things you talked about was this short gold, long miners trade, which I thought was very interesting. So let's start with spot gold first, and maybe you can give people a little bit of background as to why you would be a good person to talk to about gold and gold mining, and then we'll get further into it.
Well, I'm not sure I'm a good person. I do have a lot of experience doing this for over 30 years, first at Salomon Brothers and then at Carrollton, where I ran my own fund. Salomon, I was part of the management team as well as a partner of the Salomon Brothers hedge fund group for about 10 years. Had quite a bit of experience in the metals and mining as well as the physical commodity. So whether I'm a good person or not, well, that remains to be seen. But I do have a lot of perspective, maybe that can be helpful, and can give some thoughts on what I think of gold and silver. And I can give you those right now, which are I'm neutral on the physical markets. I think that, and I think you could ask any miner, senior, mid-major, or even junior, what they would like. And if I could sign on a piece of paper, gold price at 5,000, silver at $100 an ounce, and I would give up all the upside, I would do that in a flash of a pan, and then I would turn around and I would hedge with oil, and to lock in that oil price, and then I would have a built-in extremely high margin for my production. That's what I would do if I were a senior. As a junior, gold price and silver prices could go higher. I'm not betting on that. There has been a massive run, and a lot of wealth has been created. I do think, and I've said this for the last 2 to 3 months, that the best risk to return today is actually in the equity side of it, not in the physical commodity. That is where I can go down what I think on average, and this is just more for illustrative purposes. The senior miners are pricing in 3,500 gold. The mid majors are pricing in 3,000 gold, and the juniors are pricing in 2,500 gold. Well, someone is right and someone's wrong. Historically, and I'm going back my 30 years, almost 30 years of experience in this market, the equities tend to do well after the first major correction. So we saw a big correction from 5,600 in gold down to about 47, 4,800. It would happen within a few days, actually. One could actually call it a crash. Silver absolutely crashed. And now it's stabilized. The market, the equity markets, meaning the precious metal equity markets, are probably waiting to see if there's any more downside. Once this market starts finding its legs again and starts going up, which it has, you're going to see the equities rally. And you have, in the case of my company, A2 Gold, we've had this massive run. It's then pulled back a little bit today. We hit an all-time high this morning. And it's just a great position to be in. We're cashed up and ready to go. I do think there are some other juniors who are also catched up, and just not to focus on A2, I think the whole sector is significantly healthier. I'll give one final data point, and it actually happened to me this morning. Had a good call with a a London-based individual who's very well connected with the commodity and the precious metal funds, and the amount of inflows they're getting into their funds is as high as it's been in their history. That bodes really well. That money has to be put to work. I'm a strong believer now, and I'm ready to call it, although I'm sure the markets will do its best to prove me wrong, that we have hit a bottom on the equity markets, on the precious metal equity markets, and we are now in a bull market. I haven't said that. I haven't said that in 15 years. This is, I believe, the beginning of a bull market. Now, the key word is a beginning. We're not even close to the middle innings or the ending innings. We are in a beginning part of a gold bull market, an equity gold bull market. I remember, it would go up 200-300%, then drop 50-60%, then the next 200%, then back down 40%, then the next 200-300%. Get ready for volatility, but there's no better sector in the world that I know, that I can think of. That includes technology, the Bitcoin, the AI, or any other sector that has a better risk to return than the precious metal equity market. Now, I've been talking for about 10 minutes. I'll keep quiet and take your questions.
No, you're good. I wanted to show people a little bit on the screen, some of the stuff that we're talking about. So gold itself, right? There's been this big run in gold, especially, year to date, even with what, we talk about as a potential crash. It's still up 14% year to date and up 73% in the past year. A2 Gold has now truly surpassed this, right, with AU.V, which we've been talking about a little bit here, your company. So casual 850% in the past year compared to that 70%. And on the year to date, up 62% and really no pullback. And I wanted to talk with that first with you. So when people look at gold, right, when you get to this point right around here, there's a cliff that drops off, right? And then it's kind of leveled out. But your stock never really had said cliff, basically just kept on moving up, consolidating, maybe a small pullback in the latter portion of December, but then just pushing through to all-time highs. Why do you believe that, when gold had that drawback, the miners, especially A2, did not see that drawback?
Well, I think the senior miners had a very big pullback day. We didn't see it, but I think it has to do with two reasons. This is just my opinion, of course. The first is that I believe we were dramatically undervalued starting at mid last year, and we started making some inroads and catching up. And I think it was two main reasons. One is we finally bit the bullet and raised money. We hadn't raised money in over 4 years. We've got to be the only junior in the world that didn't have to raise money. The second thing is that we brought in very strong investors. So we were extremely selective on the investors we put in to the stock. Now, the third reason, which is more recent, is that we initiated a accelerated bonus warrant expiration or conversion, and we had over 80% participation, which is unheard of in this industry, where 80% of the people voluntarily elected to exercise their warrants ahead of time, and I mean over a year still left on these warrants, and yet they chose to exercise early, and in return we gave them a bonus warrant at $1, a very small 1/3 bonus warrant for everyone they exercise. We were able to pull forward those warrants, eliminate most of them from the cap structure, and in return also get another additional $6 million in capital besides, in addition to the strong balance sheet we currently have. So I think that had a lot to do with it. I think bringing on a very high profile and a first-rate VP of exploration such as John Marma coming on had a major difference. I mean, John is very well respected. He was highly recruited throughout this industry, and it's a very, very competitive market for juniors and mid-majors for talent. It's fine. It's funny that some of the best-known geologists and exploration geologists, as well as geotechs that I know, are having multiple offers, and they're choosing to stay with the juniors and the mid-majors than go with senior companies. They just don't see the upside for their own, primarily for equity reasons, but they feel that the juniors offer a much better risk to return. Now, these people could command significantly higher base salaries working at a major company than they are working at a junior. But pulling in a John Marma, and I think that's just the beginning of many people we are constantly getting. I've never been part of any company where the CVs, the resumes are flowing into us almost on a weekly basis. And the amount of people who are very talented people who want to come and work with A2 Gold is extraordinary. We're pretty excited, and I think all those things, those confluence of factors, people really starting to get to know the story of A2, believing that we were grossly undervalued. And one of the reasons we were grossly undervalued is we just didn't want to raise money and dilute. Where all the management executives and the directors are significant shareholders of the company. All of us have put significant amounts of capital. This is not free equity we got. We came into the company, we took over the company in 2019. There was almost no free shares we got. We were the single and have been the single largest buyer of shares in the open market. So,
and continue to buy over the last few months, right? There was more buying.
Yeah, there's more buying. I think you'll see some of us exercising our warrants as well in part of this. And there's been options that we've exercised. I know that I'm not sure if I filed, but I exercised some of the options as well, and the warrants. And by the time this comes out, you'll see the filings. But we are big believers. We continue to believe that we're grossly undervalued at a $5,000 gold price. We're probably not undervalued at a $2,500 gold price, but gold is $5,000. It's not $2,500.
A lot of pieces of what you just said that I want to speak to. First, I do want to share my screen once more. But for those watching, this is kind of the important piece right here within this industry. So a couple of things. First off, you did talk to some of the larger ones, and we've talked about how Barrick Gold, right? They're kind of the one up there at the top. And as you can see, right, they did have that pullback like you discussed, right? They went from here and, all of a sudden they're down here and they had a fallback of maybe 10% plus. Yeah. KGC, which we've kept a close eye on, Kinross Gold, and they've had a even stronger start to the year. They're up 15%, trading at $32, but still, right, still a pullback in those areas. So what you're saying is, I think a lot of gravitational pull here towards the junior mining area, and that's continued to do really well. So if people look, for example, at GDXJ right here, we could take a look at some of those junior miners and see, that 160% number right there. And it sounds like from what you're saying that, this right here, this chart is the one to be looking at, or, whatever people want to look at in order to see junior miners. But this is where a lot of the opportunity is. People that are very valuable in this field that you would want to be recruiting to your firm, if you're a gold firm, are going to those junior miners, going to the exploration firms, rather than the, large cap established miners in those areas. And I think that it's because they see the opportunity and what's coming. And it's specifically what you just said right there, right? It's the re-rating of gold. So can you explain to me, how these companies essentially get re-rated based on gold's price? Like, what does that catch-up process look like? Is there a typical lag? Is there some type of organization people are looking to for guidance on this?
All very good questions. Before I answer those questions, and you can remind me if I go off on a tangent, but I just want to address the GDXJ and the GDX index. So GDXJ historically, and I'm going back 20 years, when it first got started, was a true junior mining index of gold and silver companies. Today, that is no longer the case. I believe when I talk about junior mining, I'm talking companies that are under $1 billion. There is no real index that reflects that. If you look at the composition of the GDXJ, I think the average market cap now is close to $7 or $8, $10 billion. And so that, to me, does not reflect what I would consider the junior index. GDXJ many years had to constitute the index because there were just so many companies that were disappearing during the, a very, very brutal bear market. Now, to your question, in terms of, excuse me, of re-rating and what it takes, I think it's a function of time and price. And so today we have the price, gold going up to 5,000. People don't believe it. This is always the case, at least in my 30-year experience. People just don't believe it. And it's what is called the creeping or the sneaking bull market, right? It really is a quiet, the first legs of a bull market are just are stealth, right? So like, people do not believe it's happening. Gold, no one believes gold's at 5,000. Henceforth, you see the pricing of these juniors. Now, how to value a junior? I think there's many ways, but I think that the probably the best way is a multiple to their NAV or their net present value of their asset. So you need to start with calculating what's the value of their asset, what's the gold price, what is it going to cost them to put that into production, fixed costs and capex, and then what are the operating costs to mine that, then pull it all the way back into a net present value number. Typically what's used is the risk-free rate, historically that was around 3 to 5%. I think it's now 5 to 7%, depending on what, who you want to believe. And then generally juniors trade at, so exploration junior companies with resources like ourselves typically trade between the 0.3 to 0.5 of value of that. So it's essentially a fraction of that. So if you look at, an asset that has 1 million ounces of gold that is, can produce gold at $1,500 an ounce, has a capex of 500 million or 400 million, and gold's trading at 5,000, well, they're going to be, let's assume they can produce 100,000 ounces a year. Well, that's 350,000, that's $350 million a year, right? And let's assume there's taxes associated with that, but call it 250 net free cash flow, including sustainable capex in there for 10 years. Then you pull it all the way back. You're looking at potentially $1.5 billion mark of value for that, roughly. And then you take a 0.3 times that, which is your multiple, let's call that, and you're at 450 million. That's the value, US dollars. That's what the value of that project would be, the company. There's other ways around, which I promoted as well, which is a percentage of the spot price times, if you want to do it just a quick and dirty, well, you have 1 million ounces of gold and gold's trading at $5,000 an ounce. Well, the historical value of that inferred resource, a little bit more valuable if it's measured and indicated, but is about 3% to 5%. So 3 to 5% of the spot price times the value, the number of ounces you have in gold. And that gives you more or less, essentially will come up to almost the same value that we just calculated on a net present value. What is it going to take is the final part of the question. Once again, it's time. It's people getting comfortable with gold above $4,000 to $5,000. Remember, gold was sitting at 2,000 for a few years. It came back to 1,700, rallied to 2,300. Then it broke out. Once it broke out, it didn't stop at 3. It went to 4. 4 was just a hiccup, essentially straight to 5,000, right? And as time goes by, and you'll have some of these corrections, and every time these corrections base and then go back up and retest highs, or feel as we haven't retest, we're in the process potentially of retesting this high. People then feel that there is a support at a level of gold price, and let's call that 47, 4,800 right now, because that was the first stop. As long as that's not broken, then you'll see people getting comfortable using, whether that's a 3 to 5% of spot, and let's assume that their number for spot is 2,500 today, but on its way to 3,500 next. So I think what's happening is, just as people get comfortable with higher gold prices than the 2,500 that they're using today, I think most projects are using 2,800 gold. That's every PEA that I've seen, or ones that's in scoping study. We do scoping studies all the time. 2,800, 2,500. The next level, when we do our next scoping study for internal purposes, we'll use 3,500. Even us, we're not using 4,000, 4,500, or 5,000. So once that happens, then these the companies re-rate. Now, that's the intrinsic value, but there is an actual another factor, which I think far outweighs in terms of importance that I just talked about. It's people forget, and I, as a hedge fund manager for many years, my best years were never looking at what the PE ratios were or the fundamental analysis was. It was just looking at capital flows, right? And I would highly recommend everyone to focus more on capital flows than any other metric. PE ratios go up and down, and what is accepted as an acceptable level of a PE ratio also goes up and down. Like when I got started in this industry, if you told me something was trading at 25 times PE, that would be absurd.
Yeah.
Now you have companies trading at 60 times PE. What we've
learned
learned
is like 200 plus. Yeah,
absolutely. What I've learned is that the PE ratio is really just not relevant. And so look at where capital flows in. So why has the tech industry been beaten down the past 2 or 3 days or a week? Well, it's because there is a rotation out of tech into something else, right? Well, when I talked to my friend in London, it came very, very clear that there is a rotation starting to occur into the metals and mining on the equity side. If that, and I would put that with a high or a moderate degree of certainty, that comment. If it goes to a high degree, if I can validate that what that is exactly occurring. This sector is just getting started. It will absolutely explode to the upside because it is tiny relative. NVIDIA, just one company, is larger than the entire sector of every metal and mine. That is gold, silver, copper, zinc, whatever, all the equities combined. So there is a lot of upside to go, or NVIDIA has a big downside to go. And I'm not just trying to hear to pick on NVIDIA because they're an amazing company with huge free cash flows. But I think that if you were, markets are discounting mechanisms. And if you're looking at NVIDIA and you say, well, they already have an 85 or 90% market share, I'm not picking on NVIDIA. Well, where's the future going to go? Even if the sector is growing at 20%, they have 90% market share. They're not gaining more market share. So I would look to the metals and mining, which is really an underfollowed and underinvested sector. And I think that's the big issue.
Yeah, the area of true opportunity right now, kind of like I said, gold rally may or may not be over, but regardless, this is where the true opportunity is. A couple of questions from that. One, talked a lot about capital flows. What is your preferred way to see where capital flows are going? Obviously, people can look at volume. A2 has had elevated volume, especially in the past month, or so. You've had some of your highest volume days, maybe ever, in this time period. But what else are you looking at besides volume?
Well, I look at the sector. To me, that's the most important thing. So look at financings that are occurring. And in the financings, at least in Canada, you have to disclose your investors essentially. So looking who's participated, what funds have participated. And then it becomes an exercise picking up the phone and talking to these funds to see, are they raising capital? Is there inflows coming in? Also, what we tend to do, at least what I used to do at my hedge fund, but I've continued this process, is I start doing scans, and now it's become a lot easier with AI agents in there. But before it was a manual exercise. But now you can just have a crawler go in there and try to pull down every fund launch in the basic material or precious metals or any resource industry and see who's launching new funds and what size they're raising money for. So all of the anecdotal data that I'm seeing is that money is flowing in. Financings are getting done. Last year may have been the best year in, maybe in the history of the junior mining industry. Now money's worth a lot less today than it was 20 years ago. So I'm not sure on a relative basis, but on an absolute basis, more money was raised last year than any in the history of the junior mining industry. On a relative basis, I don't think we're even close to the top of that of capital flow raising. So, and then you had one or two outliers that probably were 15 to 20% of all the money raised in one company. So that to me is that some of it's anecdotal and some of it is actually hard data.
Understood. For those that are watching, if you do have any specific questions in terms of gold mining opportunities, feel free to throw something into the chat or message us. Happy to take those. I see people tuning in on YouTube, leaving some comments, as well as on Twitter. We are talking again with Peter Giannoulis, the CEO of A2 Gold Corp. Very knowledgeable in this gold space, but really a depth of knowledge as well in the mining exploration. His firm, you could take a look at it, popping right now, by the way, up about 5% today. It's AUAU.V, traded OTC as well as TSXV, and it is up 814% in the last 52 weeks. Almost a 1,000% 10 bagger here if it gets just a little bit further. So something I've kept my eyes on for years. Kind of doubling back to this question just based on what you said. So right now, seeing that the opportunity for you is inside of the juniors and exploration miners, are you holding any like just regular gold, any GLD, any spot gold, anything like that? Is that a part of your portfolio still? Why or why not?
No. I've sold gold at 4,400, 4,600, 4,900, and I rolled it into some of the juniors and the mining companies. I prefer to own Kinross, for example, if I wanted to go conservative. I prefer to own, if I really believe that gold was going to stay at 5,000, forget going up. Kinross continues to be by far and a large a way the best play from a leverage perspective and operating leverage to the sector. Their assets tend to be, one could argue lower quality, meaning they have lower grade, they're open pit projects, they're in difficult areas, but that's exactly what you want if you're bullish gold, right? Because once they've covered that level, it's all pure profit for them. and they were grossly undervalued. I was pounding the table at Kinross at less than $6-7, and you take significantly less risk. I think the juniors, some of these great exploration junior companies with actual resources, I'm not talking about juniors that have an idea or a thought of finding gold. I'm talking about a junior that has actually built a resource. It's a 43-101 resource, whether that's inferred, measured, indicated. I don't get too fussed about it. But an actual technical report, I can read and make a judgment call. Those are extremely cheap, continue to be very, very cheap. And there's a lot of upside. Some of them are up 500% to 1,000, but gold is doubled. And given the metrics of when gold doubles, these things can go up 1,000% and still be cheap. I think that you'll see multiple thousands of percent. I can only give you my experience in the 2003 to 2007, 2008 real bull market in the juniors. And there were many 5, 10, 15,000% winners. You've seen it in the meme coins as well recently in the last 3 or 4 years. But I think that the juniors have a lot more to run. The better companies with great management, great assets, and cash to be able to execute their business plan. They are not expensive, irrespective. They're not even moderate given where gold's at today and silver.
What do you think of a couple of these smaller ones? Like you have a gold.com, which has had a huge run to start the year. It's actually up 50%. There's another one, Goro Gold Resource Corporation. This is a sub 200 million. It's up 90% year to date. Any of these that you're watching?
Well, I got to be careful. I'm on the board of Gold Resources, and it was just acquired by, or there was a takeout offer of Gold Resources by Gold Group at a really nice premium. So I've had 6 or 7 successful exits in my career over this
very nice
25, 30 years. And, it may not sound like a lot, but this is not, this doesn't happen too frequently. So I've had 6 or 7. This will be my 7th, assuming that the transaction goes through. Gold Resources is a major producer. I'm on the board, so I'm kind of limited what I can say. And given that we just have a takeout, we haven't put out the circular out to shareholders. I prefer to not talk about it right now, but okay. I am on the board of directors of Gold Resources, which is a New York Stock Exchange listed company.
All right. Well, you may shut me down on this one then, but I'm allowed to ask. Do you think that people are potentially looking at Gold Resources, seeing acquisition 90% move, seeing you're on the board there, you're the CEO of A2 Gold, A2 Gold up 70% year to date. We've talked about that there's a lot of potential M&A in this industry. Could that be part of what people are looking at here, saying, hey, are some of these small cap gold miners going to start getting bought up?
Well, I'll talk it in general. I think there's people are looking around, and the seniors have made a move, and so they've crowded out. Let's say you're Fidelity, you got crowded out, and that's a poor example, but let's say your XYZ fund, you get crowded out of your position of Barrick because it went up a lot. Now you start moving down the value chain or the market cap chain. I do think I see that. I don't see it happening too much on the sub 20 million. So the micro cap, I think they're in a very tough position. But the sweet spot today is the 100 to 500 million market cap companies. And you saw that with Gold Resources being acquired by Gold Group. One was 500 million US and one was 200 million US. And Gold Group making that bid for Gold Resources. Once again, I'm on the board of Gold Resources, so I won't comment on it. But I do think you're going to see those because there is pressure for these 100 to 500 million market cap companies to get to the $1 billion list in the United States and then take it from there. So I think I do see it happening, a lot of M&A happening, but it's going to happen just coincidentally in the sector that A2 Gold and Gold Resources and Goro or Gold Resources is positioned. That's coincidental. I'm not trying to push that sector. That's where the real value is. And by merging these companies, now you can scale those to $1 billion a lot quicker. It's very difficult to do that by buying a $10 or $20 million company. You just can't buy enough of those companies to add up.
Okay, I've got a couple questions off of that. First off, just bringing it back for a second to the gold thesis, because we talked about this in a lot of our earlier conversations around, the devaluation trade, right? People should get into hard assets. The dollar's going down. Also, countries around the world are buying up a lot of gold to use as stockpiles. Is what's the because there has to be a thesis obviously behind that to hold gold up so that the miners can have this move to the upside. What does the thesis around gold boil down to for you, for those that haven't heard it on the show before?
Well, I think that the world is, after what has happened over the last 6 months to a year, and this is not a political statement, just the U.S. becoming a little bit more aggressive with their partners like NATO or the Europe. I think people, and I thought the greatest mistake made in the history of my experience in economics or the capital markets was when the Biden administration confiscated the assets of the Russian central bank. That laid the gauntlet down, and you can almost put that down as one of the inflection points for gold, or the catalyst for gold taking off, because people started looking around saying, well, I can't trust the US. Money, remember, has no nationality. Money should never have a nationality. Money should be able to freely flow where it should go. And if US laid the gauntlet down for that, it was a very, very bad decision by the Biden administration. So I do think there's a lot of people looking around, looking for that, reserve currency. Gold has historically occupied a major role in reserve currencies.
Right.
In the day I was actually born was the day that Nixon took us off the gold standard. So, I mean,
Right.
you can Google that, you'll know how old I am and when I was born, because it was the actual date and year I was born. And I think that there is that secondary play. People are looking around and saying, well, Europe is a mess. I don't trust the euro. Japan is a complete disarray, a mess. I don't trust China or the renminbi. And it doesn't really have the depth of the market. So people are looking at gold for that. I think it's important to remember, people always talk about production numbers of gold. It's so irrelevant how much gold comes up out of the ground every year, because it is less than 2% of the gold outstanding in the world, or roughly, less than 2%. Call that inflation. So your standstill inflation in gold is 1.5 to 2%, because that's what's being added to the stockpile every year. Silver is a difficult one, because silver does have an industrial use and it has a precious metal use, right? So above stock inventories of silver is very, very small today. Silver is also prone to, I don't want to call it manipulation, but to movements, very violent movements. You've just seen it move extraordinary. I mean, I can just tell you what's for heap leach projects like ourselves in Nevada, and why this is so monumental and no one's talking about it, is that given the grade we have of silver, a part of our gold asset, our cost to produce gold would be close to zero because of silver credits, right? So give you an example. You have 20 grams a ton, which would historically be considered a low grade deposit, but that comes as part of a gold deposit. So you're not optimizing for silver, you're optimizing for gold in terms of production. That silver comes with that. In a heap leach operation, you may recover about a quarter of that. So let's say you're recovering 2.5 grams. Well, 2.5 grams today at $4 a gram is $10. So for every ton of ore you're removing, you're getting paid $10. It costs you about $2 to remove that ore. And if you include strip ratio and everything, basically that mining operation is free. And the gold comes for free if you use silver as your cost basis. So silver does play an important role. It plays an important role for us. We are a gold silver company. We're not a silver gold company. And most precious metals companies, it doesn't matter how they position or how they market themselves, if you look at what they really have in terms of value of the metal, are almost always a gold silver company. It's rare to find a silver gold company, just because the way the geology is in the world. So I do believe, to get back to your question, I do believe that there is a secondary currency that's developing to compete with the US dollar, and that is gold. It's not the euro, it's not the renminbi, it's not the yen. Today it's gold, and gold is today pushing on in terms of reserves in the central bank. It's second, but quickly closing on first to the US dollar.
Yeah, we showed that chart a while back. It's really close, the way that it's moving. Should pass it pretty soon. All right, 2 more questions within here. So you started rolling into silver, which I did want to talk about. I just wanted to get your general thoughts on this broader rare earths, precious metal trade that's happening right now. Specifically, silver people talk about, but also copper has become very, very talked about. Uranium, um, copper is a big thing for me. So I kind of just want to hear your thoughts across the board here.
Yeah, I mean, so gold had this huge run, silver had this massive run, copper's had a good run. Like copper, the issue with copper is that it's so sensitive to economic activity. So gold may actually be inversely related. Copper is completely related to activity. Now, the real play on copper is that it's the best conductor of electricity. That and silver, the two best conductors of electricity. So if you're a big believer in data centers and AI, well, you need copper, right? Copper has to be a play. It doesn't matter if it's being if that energy is being generated through a nuclear plant or coal or through hydro or whatever. The transmission lines need copper, right? You need to transmit that through copper in general. So copper has an amazing future. I'm a big bull. If you were to ask me the one precious metal or one metal, in this case, basic material metal, I think copper has a lot way to go. It's very hard to play it in the junior. Copper is a business for the seniors. It's not a business for the juniors because the size of copper deposits are so large. They need to be large for the economies of scale for it to make sense on an economic basis. So big fan of copper. There's very few juniors out there to play it. It's a small market. Right now, it's just a better play, and it won't always be a better play, but it's just a better play to play gold, silver juniors because they're so grossly undervalued to the relative price of the metal. At some point, that won't happen. Then you need to, in my opinion, then you trade it out and you do something else. But I'm going to be forthright. If I've always been transparent, as you've known me for years. So when I don't think it's a good time, I'll say that, and that may not be the best thing for my company, but that right now, the single best play, risk to return, continues to be gold, silver on an equity basis.
Got it. Specifically miners.
Yeah. Well, miners are the exploration side.
Got it. Understood. How many companies just play in exploration versus exploration and mining?
Well, there's far more exploration companies. When I ran the fund, I only looked at exploration companies that actually have an asset or resource or reserve. So I would eliminate 70% of the junk out there. And there is a lot, I think there's some fine companies that produce that are trying to do the right thing. But as an investor, and investor most of my career, I would only look at companies where I have a technical report. I can validate those numbers. I can talk to a geologist. I can talk to the resource consultant. I have something I can hang my hat on. It's nice to say we've acquired this property, which is next to a gold mine, but there's really nothing here. Well, where there's smoke, there's fire. Great. I agree. I'll wait for you to come out with a resource. Maybe I'll miss the first 200%. I'm good with that. But once that resource is there, then I can look at it and point, poke holes at it or just realize this is a perfect project, which is never the case. But, I can value it based on some metrics. I can't, and I would say the overwhelming majority of these exploration companies have nothing.
Good to be honest about it. Why do you think A2, we talked about this a little bit before we went live, but you're outperforming the peer group right now. But based on the thesis that we've outlined, it would seem that the peer group, specifically in this area, would have more room to the upside and continue to move and, not have dips like Barrick and KGC and others have had recently. Do you think there's a specific reason that you're outperforming the peer group? Is it mainly the capital structure, the funding, the way that you've gone about it?
Well, I mean, let's start with a peer group first, the definition of a peer group. I just came back and said most of my peers don't have nothing, right? So I consider my peer group Western United States exploration companies in the gold and silver, and maybe there's 5 to 7, which I would consider my peers. We have outperformed them, but once again, I think that's just more of a function of a lot of the catalysts we've announced. We started a major 30,000 meter drill program. We hired a high profile VP of exploration. We accelerated the warrants this year. Just so many things that are going on with us and so many more things that are going to happen over the next 3 to 6 months that I think that has a lot to do with it. I think people realize that for good or for bad, but we've been very conservative and that is now playing out. So we never diluted, we spent 3 to 4 years without diluting our shareholders through equity issuance. And that to me made the difference, because when the markets did turn, we had an extremely tight capital structure and no one else did, really.
Yeah, well put. And then just one last thing I wanted to touch on. You recently did an interview with Carl from Follow the Money Investor Group. Any big takeaways, anything you'd want to share with this audience from that interview?
It was an interesting interview. I mean, I think we did it was one of the interesting ones. I think that was the one with the car, right? Where we
was
were
in the car, yes.
Yeah. And it was in Vancouver. It was a week and a half ago. I think I talked more about making my baguettes, which I just made last night.
Oh,
And so I thought it was an interesting interview. I've never done that where I was driving in a car. It was more of a chat. But you know, a lot of things I talked about today, I think I talked about. Then I mentioned, you know, how I think investors should hedge their portfolios. I talked more about as a hedge fund manager rather than a manager of or a CEO of an exploration, a junior mining company. And those were the kind of the takeaways. I spent a lot of time talking about different types of strategy and how to play the gold and silver market and how to hedge and how to use hedging as a play and put spreads, because the volatilities were very high, the implied volatilities. And I thought that was the best way to hedge it. But I would, you know, if it just happens to work out that, you know, if you had bought A2 gold at that time and hedged your silver or gold, you'd be up, you know, a lot.
yeah, yeah. No, we gave out that same game plan, you know, on our live stream that we did just a couple of weeks ago. I think we were outlining the same thing. So it makes sense to me. This was really well covered. I think gives people continued confidence in this gold mining exploration space, specifically the juniors. Don't be too worried about, you know, gold, the asset itself. Hopefully stays stable. You know, find some stability. Not a bad thing if it doesn't go right back up to 6K right away. Let silver settle around a little bit. Appreciate the thoughts on copper as well. Anything else that we haven't touched on today that you want to make sure that we go over?
No, I think this is the first time I've come on, and now I have some hard data that there is capital flows coming into the sector, and I think that's the single biggest thing. You know, this reminds me of 2003, 2004, the last real bull junior market, and you know, things went up 200-300%, and people say, well, the rally's over. It was just getting started. They were up. The average sector was up, I think, 1,000%. Many companies were up 10,000%. I'm not saying that will happen now, but God, all the elements are there.
I love that. I love that. That's a fun note to end on.
All
Peter,
right.
always a pleasure having you on. Hope the travel continues to go well. Any final comment before we close out?
Nope, I'm off to the airport in about an hour, so we'll talk later.
Safe travels. Thank you to everyone that tuned in today. We had a good audience over on YouTube, plenty that tuned in on X. If you have questions, feel free to message them to me and we'll get them in on the next one. We will do a space Monday night, 6 p.m. Eastern, and that will be our next gold conversation. Thank you, Peter. Thank you, everybody.
Thank
Talk
you.
to y'all soon.